Hey everyone, and welcome back. Today's explainer is a really deep dive into a uniquely balanced tool in the financial markets, the Nifty 500 Large Mid Small Equal Cap Weighted Index. It's an incredibly innovative approach to market representation, and by the end of this, you're going to have a crystal clear understanding of exactly how it works. Let's get into it.
So here's our game plan for today. We'll start by decoding that complex name, then we'll look at the equal weight calculation method, the rules for rebalancing, sector weighting, and constituents, and finally, we'll wrap up with why this equal cap weighting actually matters.
All right, let's jump right into Section 1, Decoding a Complex Name.
Okay, so the Nifty 500 Large Mid Small Equal Cap Weighted Index. I know, it is an absolute mouthful, right? But in the world of indices, a name like this isn't just branding. It's actually a literal instruction manual for how the whole thing is built.
If we just break it down and read it phrase by phrase, it basically tells us everything we need to know. Nifty 500, well, that's our universe, the top 500 companies. Large, mid, small means we are including all three major size categories. And that last part, equal cap weighted, that's the secret sauce. That tells us exactly how those categories are balanced.
To really appreciate what this index is doing, we kind of need to compare it to the norm. In a standard market cap weighted index, the biggest companies, the mega caps, they totally dominate. If a company is huge, it takes up a massive percentage of the index, which means its performance basically dictates everything. But this equal cap weighted approach, it's aiming for democratic representation. It forces balance, making sure those giants don't just completely overshadow the mid-sized and smaller companies.
Which brings us to Section 2, the equal weight calculation method.
Imagine the market is a giant pie. Normally, the mega caps would eat like 80% of it. But this index, it slices that pie into three perfectly equal pieces every single time it rebalances. So large cap gets 33.33%, mid cap gets 33.33%, and small cap gets 33.33%. It's just elegantly fair.
But, and this is a really crucial nuance, while those three broad buckets are equal, the individual stocks inside them are not. Actually, inside, say, the large cap bucket, those stocks are still weighted based on their free float market capitalization. However, as a group, they can never ever exceed their 33.33% allocation when the index is reset.
Okay, moving on to Section 3, Rules for Rebalancing and Maintenance.
So how does it actually maintain this perfect balance? It follows some pretty strict mechanical rules. Step 1, the parent Nifty 500 index is reviewed semi-annually. That just figures out who even makes the cut to be in the pool. Step 2, equal segment weights are assigned to those large, mid, and small categories. And step 3, this is the big one. The index is rebalanced quarterly. That quarterly reset is absolutely vital because it trims down the segments that grew too much and tops up the ones that shrank, forcing everything right back to that perfect 1/3 split.
And just to put the scale of this into perspective, this index tracks exactly 500 constituents. Specifically, it includes the stocks that are forming or going to form part of the parent Nifty 500 index at the time of that semi-annual review. Basically, if you're in the parent index, you're eligible for this equal cap version. Plus, like any standard index, it needs a starting line for all the math. The calculations here are rooted to a base value of exactly 1,000, which was established on its base date of April 1st, 2005. That just gives analysts a really solid, consistent baseline to measure historical performance against.
Shifting gears a bit, let's look at Section 4, Sector Weighting and Key Constituents.
Now, this is fascinating. Even with that forced equal cap weighting across the size segments, financial services still completely dominates the top spot. It takes up 28.16% of the total index weight. That's largely driven by heavy hitters like HDFC Bank and ICICI Bank. Coming in a distant second is capital goods at 10.72% and then healthcare at 9.80%. If you look at the broader top four here, you can really see how sharply the weight drops off after financial services. Like I said, capital goods and healthcare are hovering around that 10% mark, and then automobile and auto components steps in at 7.43%. Honestly, understanding these top sectors and the big stocks driving them, like Reliance Industries and Larsen & Toubro, it's absolutely essential for mapping out the macroeconomic forces that actually move this index.
Which brings us to our final part today, Section 5, Why Equal Cap Weighting Matters.
So, why should you care? Well, equal cap weighting is a strategy that gives smaller companies a truly meaningful impact on overall performance. Think about it.
In a traditional 500 stock index, those bottom 250 small cap stocks, they barely make a dent because they're completely dwarfed by the top 10 mega companies. But here, that small cap segment is literally guaranteed a 33.33% voice at the table.
The official methodology spells it out perfectly. Each segment, large, mid, and small, in the index, will be assigned equal weights at the time of rebalancing. It is a strict rule, and it entirely redefines the risk and reward profile. It basically prevents a scenario where just a handful of massive tech or finance giants dictate your entire view of the market.
So I'll leave you with this question to ponder. Does guaranteed equal exposure to large, mid, and small cap segments provide the specific portfolio balance that you are looking for? Understanding these kinds of mechanics is really your first step to mastering market data. Thank you so much for joining me for this explainer today. Keep exploring, keep analyzing, and I'll see you in the next one.